I use 3 big tax saving opportunities to help my business owners pay less than 10% in taxes every single year. Hi, I'm Jacqueline Matoza. I'm a retired Fortune 25 CPA that saved extremely wealthy people over $1 trillion in my 20-year career. Now my mission is to rebuild the middle class of America and do this by helping self-made millionaires protect their money and exponentially grow their wealth using the same strategies I deployed for my billionaire clients. In this video, I will walk you through the 3 big tax saving opportunities I use to help my business owners pay less than 10% in taxes every single year. Before we begin, just so you know, everything I talk about is purely for informational purposes and is not to be taken as financial advice. Your situation is yours and everyone is unique. Cool. Let's jump in. So no training, no on-the-job training, no training whatsoever. So these 70% of the CPAs that are working, they're doing the bare minimum. They want to make their $300,000, they want to do their clients' work, and they want to just get their stuff done for tax return season and move on. They're not in their offices every day. They don't want to work every day. They work 60 hours, they work 6 months out of the year. And they don't want to do the grind that everybody else is doing because it is a very taxing career. So because of this, because they're aged, they are stuck on 1986 tax laws. But what most of them have missed is that in 2017, we had a very large tax reform bill that came through, and they are not using that. They are using a peanut butter approach for all of their clients and putting the majority of them into S Corps. If you are making over $1 million, you should not be an S Corp. Very, very rare people at that level should be an S Corp. So don't get me wrong, S Corps have their purpose and they're great if you have a large number of employees, a lot of assets you haven't depreciated, or you're only making $250,000 or less, because you're saving on the payroll taxes and you're able to bring all that money into your pocket and not worry about it. But once you start hitting over 250,000 single, 500,000 married, we really want to start evaluating your tax situation and make sure that you're not tripping over dollars to save a penny on payroll taxes. Because the only thing that gets double taxed is your W-2 income. If you pay dividends in the C Corp space, which we'll talk later, there's actually new laws that are more favorable. So we need to make sure that we separate and make sure you're not tripping over the dollars, which is your income tax, to save pennies, 7.42% on your self-employment and payroll taxes. So this is where we really have to run numbers and do financial modeling, which 99% of CPAs don't do. And this is the first thing I go through with you, and the first thing I give you when you're my client, is we go through and analyze this. Why? Because I push most of my clients into C corporations if I can. Not every client can because they've been operating as an S Corp for a long time, but I can do their planning on an individual basis. So let's dive in. The big white lie about C Corps that every CPA is spewing right now is that there's double taxation in C corporations. But it's because very few CPAs know how to operate them, understand how efficiently and effectively they can maximize deductions and push income out of the way. So let's use a very simple example. Again, you can Google this, it's tax law, you can find the tax code or summaries of very reliable sources like Vanguard and good sources. So if you're married, I can take $96,700 out of your W-2 income and pay you from a corporation as a qualified dividend. So in order to be qualified, you have to own the corporation for over a year. There's these holding periods and these rules that we have to apply. I can pay you that $96,700 with 0% tax. How is that double taxed? Then, if you need even more money, I can pay a dividend up to $600,000. So between $96,700 and $600, and it's only taxed at 15%. How is this double taxation? If you made $600,000 in W-2 income, you would pay payroll taxes, Social Security, FICA, Medicare. You'd be paying literally up in the 35% tax bracket for income, federal income taxes. Yet I can pay you a dividend for 15%. This is why the wealthy are wealthy. They have a different set of books that they're operating on. They have different rules they're applying, and your CPA doesn't know them because they missed the 2017 tax reform. So let's talk about why C corporations are important, and they always have been. If you look at the Treasury Department's budget, this is public records, fiscaldata.treasury.gov. You can go to the website. C corporations pay less than 10% of the income taxes and the Social Security Medicare taxes. They only employ 8% of the people in the United States, but they are making over 2/3 of the GDP. There's something here in the secret sauce of a C Corp if they're making 2/3 of the money and they're paying less than 10%. Now, if you look at self-employed or working individuals, they're paying 85% into the Treasury Department's budget. Does this seem fair? No, but your CPA is screwing you, and that's where you need to get educated, and that's why I'm here. The problem that I've noticed is big corporate tax planners like me, they don't want to come out of their fields. Why? Because they're making big paychecks, they're comfortable with their jobs, they know what they need to do, and they don't want to start a business. They don't want to deal with it, and they don't really want to help others because they know the very, very wealthy are going to make sure that they're paid. So they don't help self-made millionaires and everyday Americans. The other thing that CPAs don't know is that C Corps have 27 additional ways to save on taxes that you cannot do in S Corps, LLCs, partnerships, or sole proprietors. All of those pockets on your pants that go under your 1040. We have to separate the income into a completely different tax return and a completely different legal entity. And this is really important so you can protect yourself, because the corporate tax rate is 21% flat tax. And in 2025, Donald Trump has proposed to reduce it to 15%. And this is much, much lower than anything you're ever gonna pay if you are an individual. We have the tax brackets at 37, and in fact, the new bill is increasing poor people's taxes up to 53% more in taxes. So it's clear the rich are gonna take care of each other. They're gonna make sure they're taken care of. They're not here to help you guys, but I'm here. So let's kind of dive through what typical CPAs tell you for tax planning. The top two that I get told all the time is, oh, I need to buy Airbnbs. The problem with Airbnbs is you're already busy. You have a business, you're doing things, you're busy. Your Airbnb is now a business that you have to manage and run, or hire somebody to do that and lose money in your Airbnb. The other issue with Airbnbs is the tax regulations are coming through, changing them. In Las Vegas just recently, you can only have one Airbnb short-term rental. The rest of them have to be midterm or long-term. That is going to cut into your profits if cities and counties decide to change the laws. And so I always tell people Airbnbs are risky now because they're protecting the hotels and they're protecting what they need to for their areas. And also higher net worth areas are much stricter. They don't want parties in homes. So you're not going to be able to make as much going forward. Are there still good areas? Yes. Are there great counties where you can make a lot of money? Yes. But you have to be on top of your business, and you have to understand the real estate trends and stay on top of them, and you already have a day job. The other thing I hear people tell me about is like the Augusta rule. Oh, I can rent my house out from my company and I can take tax deductions. That rental is only less than 2 weeks, less than 14 days, okay? So you can only pretty much charge maybe $10,000. That's not gonna save your hundreds of thousands of dollars. This is terrible advice. Plus, if you're really wealthy and you have a mansion, do you really want people in your house where they could steal your jewelry? They can go through your house and take things? Because that's what happens when you have people in your house when you're not in it, or you have people over hosting. You don't know what they're gonna be doing in your house, and personally, I don't want them touching my stuff. So I don't like the Augusta rule. I don't use it. I don't want anybody knowing where I live, and I don't want anybody knowing anything about me. So these are the main pieces of advice that people come to me and talk to me about, and they're really, really not that great of advice because they're not gonna help you get into the hundreds of thousands of dollars of deductions, which is what people like you need when you're a high net worth self-made millionaire. You need better advice, you need better strategies, and you need them to be executed properly, because I'll tell you point blank, you're only as protected as your advisor. If your advisor has no idea what they're doing, they don't pay your bill, you pay the bill. You pay the penalties, you pay the interest, unless you can prove that they didn't know what they were doing and they were negligent. And that is a not fun place to be with the IRS. So really, really, really careful that you use these carefully and you have the right advisors. There's all these people that want to do YouTube University and TikTok school. And like, let's be really honest, you cannot execute these because you don't have the training, you don't have the education, you don't understand the nuances. So don't cut corners and do it on your own, because this is not the way to do it. You really need the right advisor and the right person, and I promise you, the right person will make you more money than you could ever make yourself, and that's what's important. So now let's go dive into my 3 and let's break these down for you. All right, so let's talk about my 3 big swings, what I use to really maximize the deductions on self-employed people that are in C corporations. These are mainly really, really good for C corporations because we want to pull that money away. We want to re-pocket it. You can do some in other entities, but really we want to maximize your tax savings and get you at that flat tax 21%. So the first thing that I talk about is captive insurance. So what is captive insurance? Captive insurance is a company that you are going to form. It's your own insurance company where you get to put the terms in place and the scope in place based on insurance laws and rules. This is why you need the right advisor to set this up for you. You don't just get to do whatever you want to do. But the goal of the captive insurance plan is to protect you where you don't have protections. What's important to know about a captive insurance is you have to have at least $100,000 minimum premium. Okay, so this is a big deduction. It is a commitment. You are setting up a company. This company has pros and cons. So let's go through the pros. This is a premium, insurance premium expense to the company. It's a one-sided deduction. You're gonna make the payment in the corporation and the money is gonna go into the insurance company. The insurance company is gonna buy a bunch of stuff like stop losses and all this other stuff and stack your insurance to protect and also leverage what you're putting in, which is how insurance companies work. So it's a one-sided deduction because you're putting the premium in, but you're getting the money back in your pocket as expense reimbursement. So if you have an expense that you can put against this captive insurance plan, it comes back tax-free and reduces your expenses that you covered. So this is a one-sided deduction in that your premium is a deduction, and then when the money comes back to you, it's an expense reimbursement. This is really important because this is how we get that one-sided deduction, and it doesn't go into your income. It just offsets the expense line where you had to pay money out and submit the cost to get reimbursed, or submit the costs and then get them paid for directly. The goal of a captive insurance is to reduce risk. Let's talk about this. So it reduces risk. I'm oversimplifying this because I want everyone to understand. If you're a solopreneur and you are the only owner of the company, your company is doing so well because you have all of the mind management and decision making, and you already know what to do, when to do it, how to do it. You know the sales and marketing all the way through the operations, the trifecta of business: sales, leads, and ops. If you don't have good sales, leads, or ops, your business is going to suffer. So if you go away, now you need to hire somebody in. Let's say you get in a car accident, you get hospitalized, you need to hire somebody to do the work. You can't do it yourself because you're going to be hospitalized for a period of time. We want to make sure we can hire somebody, and we want to make sure that you have this forever with you. So this is how it minimizes risks. It covers any health insurance, any co-insurance, dental that doesn't get anything your current insurance policies don't cover, personal injury, general umbrella policies, health, dental, vision. It will cover those costs and reimburse you. So you need to make sure you have the right employee reimbursement plan in your company. There's a whole thingy-mabobber around this. So you don't want to commingle your money or you lose the protection of the C corporation because you pierce the corporate veil. So we really need to make sure that everything is done properly from a bookkeeping perspective. And this is why you need good professionals on your side. The other thing is, like I said, you own your own insurance company. That means this insurance will stay with you throughout till you die or run out of money. Health insurance costs are increasing. Long-term care coverage is increasing, all kinds of things are increasing, and people don't have the proper coverage. And I'm seeing this across the board. People are calling me more and more, how do I leverage that life insurance policy you talked to me? How do I leverage this? How do I leverage that? They're trying to access the money because they don't have the right plan. So now, what are the cons? Let's talk about this. The premium payment is gonna go into this new corporation. So the money has to go into the plan. Then any income that the insurance company makes is taxable. So there will be expenses and there will be income just like anybody else, and it's a C corporation. A captive insurance is a C corporation. So just like we work on your stuff, we can work on the captive plan. The other thing is we need to make sure that this is executed properly, you have the right plan documents, and you have the right lawyers reviewing this. This is super important. You're only as good as your advisors and your mentors. You only know as much as what they know. So if you're learning from some Joe Schmo tax strategist, they aren't gonna know how to do this because they've never been trained properly to do this. So that is how captive insurance plans work. You put the money in as a premium, you buy insurance, stop loss, all of these things that have to go into it. There's a whole stack of stuff, it's a whole thing. And then you select what plans you want and what you want to put in it, what you don't want to put in it, depending on the premium costs. And you have to have $100,000 to invest in it. But the beauty of this is it can really protect you from business disruption like COVID. It can help you from if you have a loss in revenue one year because you lost a client or something's happened, you got sick, you can get that reimbursed. There's things in there that can really help you and protect you as well as reimburse you for anything other insurance companies didn't pay, personal liability, that kind of stuff. So it's pretty cool and it helps you. This is how all of my clients that were self-employed were able to get through COVID without any issues. They literally just pulled from their captive insurance plans. This is what every Fortune 500 company has. Walt Disney has tons of money in life insurance and their own captive insurance plans. So it's super important that you follow what they do. You don't need to recreate the wheel. You just need to find somebody who knows what they did, okay? The second thing that I do is a 401k. We set it up as if you're a solopreneur, profit sharing. And we add a cash balance plan to it. The beauty of this is if you are able to, if you have employees and there's small number of them and you want to benefit them, you can also have them profit share in the company. This is an annual election. You don't need to do it every year. And that money just needs to get allocated every November and you need to make a decision. You need to make the payment to the 401k. The employer pays the contributions to the employee's 401k. So if you have multiple employees, you need to think about if you want to give all your employees the money. If you're a solopreneur, this is great for solopreneurs. You can put up to $350,000 in tax deductions. Easily. This goes directly in, and think of it like a pension. Back in the day, companies would contribute into a pension, their pension would grow, and it would be in your name, not in the company's name, and everything operates. So this is just a fancy 401k where most people don't know about it and don't know how to do this. So again, this is a temporary one-sided deduction. I label it temporary. Why? Because this is taxed in retirement. To the employee, okay? So you're gonna get the deduction today. Later on down the road, when they retire, they're gonna get taxed in retirement. We can do what's called a Roth, backdoor Roth conversion. So we can convert this money into a Roth and save you so that in retirement, a portion of it is not taxed, but you want it to grow tax deferred for a long time because then you get the gain of all of that, 100% of it investing and earning you more money. So this goes to the other thing that I said, it grows tax deferred. Unless you convert it to a Roth and then it grows tax-free. Okay? And then the other thing is your 401k. Most people tell me, oh, I don't want to do a 401k. My money is locked up until I'm 59 and a half. That's because they don't know what the ultra wealthy do. The ultra wealthy use their 401ks to fund a new corporation. So when I left my corporate job, I pulled out half of my 401k and started my corporation, and my retirement plan owns 99% of my corporation. I used Roth money, so if I go and sell that company, 99% of the sale proceeds are gonna go back up into my 401k tax-free. And this is why when you're in private equity, when you sell a lot of things and you're turning a lot of things, it's great. You can set up a new company, you can build it, you can do a share sale, all the money goes back up into your retirement plan, and you're done. You just do it again and again and again. It has to be an old employer's 401k, so we have to work on these rules and make sure you fit them. And if we know you're gonna start a new business, we can fire you from one and hire you in another. So there's some nuances to this, but this is how we prevent our 401k from getting locked up forever. So you can use this as a banking option where you self-fund your own company and don't need an SBA loan. You don't need to get financing. You don't have to worry about bootstrapping. You're good to go. So these are the great parts about doing something like this. And your 401k can be used. When I go to sell my business, I'm gonna turn around, form a new corporation, and have a real estate company. So that's the benefits and the beauty of this. So it's taxed in retirement. I do not put that you have to wait until retirement because I know ways to get it out, and this is why you're only as good as your advisor. But the other thing that's really important is that the plan is done properly and the legal docs are right, because if they're not, this could be taxable and not tax deductible. So we gotta be careful and get sure we get this done right. So we wanna make sure the plan is done properly with the right legal docs. This is important because you need to make it a qualified retirement plan, and there's laws around tax codes, ERISA, all kinds of stuff. So again, a tax strategist will have no clue about this. They may parrot my videos, but that doesn't mean they know how to do it. So now, the third plan that I do is executive bonus plans. I'm gonna move this down. Why do we like executive bonus plans? We love these. This is why the CEO of B of A during the '08 crisis could take bailout money, pay executives, get fired, and basically not care. He had a parachute plan, which is not an executive bonus plan, where he was protected. So if he got fired, they owed him $450 million on firing. Then he had his executive bonus plans where he's earning either stock in the company, a cash bonus, or he's earning a life insurance policy. Depending on the company and how this is set up, you want to make sure that you do this right. So again, many of these need board approval and board sign off, and it's super important that we do the legal documents and the process and the compliance properly. But the beauty of this is every executive in your C corporation, you can take a $1 million deduction per executive. And you guys, because you control the C corporation, get to decide how you're paid. And how you're paid is gonna dictate how it's taxed. Now, this is the only plan that I have on this board that is not a one-sided deduction, whether it's temporary or permanent. This is gonna be taxed in the year of the pay for the employee. So this is a downside. So you're gonna get taxed in the year the bonus is paid. So this is important because not only do we need to manage the C corporation taxes, we need to manage the individual's taxes, okay? And so the other good thing about this is, and this is what my clients do, we do what's called a tax gross up clause. This is a legal clause you put in the bonus plan where it says the C corporation is going to pay the individual's tax bill. So it's a circular calculation because when they pay the tax bill, that's now income, and there's a lot of mathematics behind it. It's not black and white, it's not simple. So there's gonna be a gross up, and that gross up is going to pay the executive's taxes directly to the IRS, directly to the payroll companies, or franchise tax boards, whatever your local payroll, state payroll, they're gonna pay all of the local tax authorities on behalf of the individual. What does this do? This takes the money out of the C corporation and pays the bill for the individual into the tax authorities. Now, if we do our tax planning right for the individual, you will get that money back. And that's when this becomes very sexy. When you learn how to rob Peter to pay Paul, put the money in, take the money back from the IRS when you file your individual return, this is how we tax planners think. Okay, it may be temporary, we have to pay it in. If we pay the bonuses in November, the money's only there for 3 months. Why wouldn't we do that? We're gonna park it with the IRS, we're gonna file our taxes, and we're gonna get that money back. And that's what I used to do when I was in corporate America. My bonuses, my stock comp, all of that compensation was taxable to me, but I was able to do my tax planning with real estate and oil and gas, and I was able to take back all of that money. And I got all of those payroll taxes back. I paid a 2.5% effective rate between federal and California when I worked in the Bay Area. So these things are super important for you to know that it is possible and it's temporary, and we want to get that money back from the IRS. But again, you've heard me talk about these things, and we need to make sure that you have the plan docs done properly. And we want to make sure you have the right legal docs. Okay? I say this in every single one of these because if you do not execute them properly, you're not going to get the deduction on the C corporation. It's going to be taxed. If you do not have your documentation down perfectly, it's going to get taxed. And this is the risk of using bad advisors. You're only as good as what you get. Garbage in, garbage out. I'm only as good as the data you give me. The plan is only as good as the data you give me because I'm working with garbage if you're giving me rough estimates, which I don't work on because it's too much of a liability for you and for me. And I don't want to build a house of straw. It's going to blow over in 10 seconds. So when you're using your advisors, there are niche experts in the tax field that do captive insurance, that do these profit sharing plans and cash balance plans, that do executive bonuses. These, I'm not even arrogant enough to do them myself. I outsource this to my advisors that I've been working with for almost 20 years now because it's too risky for me to do it. Because yes, I know enough. Yes, I'm super dangerous. Yes, I can talk very dangerously on every one of these, but it's not my job. And I know in tax land, the rules change quickly. Every single month, the rules are changing and I don't have time to keep up with it all. So I lean on my expertise and my teams that do this. And I do white glove service so you don't have to worry about it. And I make sure that everything is taken care of for you. So I hope this helps you understand how we save hundreds of thousands of dollars, if not millions, and we're able to move the money out of the corporation into your pocket again, or into a different pocket where you can access that money later when you need it. And this is how the wealthy build their wealth. They take the money back from the IRS, put it into tax-deductible investments. Every one of these is tax-deductible investments, and they have it grow. And that's that 30%, 40%, 50%, depending on what state you're in, that is how you grow your wealth exponentially, because a penny saved is a penny earned. If you can take that money and have it earning more for you, you're really gonna be in business. And that's what we learned when we were trained in these companies. So we wanna make sure that you're educated and you understand what we're doing and that you can turn your frown upside down, and how these three big swings can reduce your tax bill by millions of dollars. Depending on how much money you have and how much money you wanna invest, we can do that. And it's super important that we protect that money from the IRS. If you want to work with me, click the links below and check it out. Book a call so we can chat and I will see what makes sense for you. Everybody has different goals. Everybody has different desires. Everybody likes different things. I've had people tell me, I don't care. I don't want a 401k. Fine. I don't think it's good advice. I don't think it's a good decision, but it's yours and it's yours to make, and we can move it into other things. So book a call. More than happy to help you, save you at least 6 figures.